Welcome back to Golden Rule Radio. We're going to jump right into gold this week with gold trading just below 1,700. It's been bouncing about $20 north and $20 south of 1,700 for a while now. What do you see on the charts from last week, Miles?
Yeah, Robert, you're definitely seeing that compression sort of building here, so I'd be expecting a breakout one way or the other in the next week or two. So my money's obviously been on down for the last month or so, and I'm going to continue to hold that line. I think we are going to see gold come back down a little bit, give it a chance to kind of build a new base, build some new momentum, and we haven't really had anything that resembles a correction since we had the big drop in the rise back in mid-March. So what about you guys? Any differing opinions on the price of gold? Not long-term, because I think we're all in agreement on the price of gold long-term, but just over the next couple weeks.
No, I'm in agreement. I was thankful for Friday's drop to around 1680, and we're seeing that again today on Wednesday as we record, below that 1690 level. And to me, those are entry points. When you've got somebody dollar cost averaging in, I take advantage of those opportunities. And certainly if you have a vaulted account or you're calling us for an IRA or something else, just remember to give us a shout and we'll tell you what those points are. But I would like to see it come down even further. I know that's counter to the investment mindset, but we know ultimately where the metals are going. So why not, as Robert says, back up the truck when we can and get fully loaded before that next climb?
Sure. And I still like the 1620 number. I mean, my 1585 from a couple months ago still kind of matters, but I'd prefer to see 1620. And then obviously anything below that is just a bonus.
Yeah, I don't think those lower numbers are as realistic as we see this increased injection of money, the money printing. And we're going to be sort of fundamentally heavy today on the show because there's not a whole lot of technical update. And I'll get into that a little bit. But it does beg the conversation and a need for definition on what is inflation versus deflation.
Yeah, I'd say from a seasonal standpoint also with gold that you want to be buying here in the next couple months before you get into the mid to late summer because we do expect some higher prices to come. So as the next couple of weeks to couple months go on, I would be ready to pounce, ready to buy. Looking into going into July, August, you want to be positioned before that.
Silver really hasn't done anything either, Miles. Why don't you jump into that chart?
Yeah, I'm not quite sure what you want me to say. It's kind of the exact same thing as last week, right? Almost the exact same price. Silver's been just riding on the lower end of this month and a half long compression. Same as gold, we're going to see a breakout one way or the other. We had a longer discussion last week about silver and platinum, just because they had started this compression a little earlier than gold. With the way gold moved up, I still, despite a little bit of market movement, especially we'll see here when we look at the platinum chart, my gut still says a little bit more up and then a correction back down. So until we see a breakout, we can't know for sure, but I'm still looking around 1675 maybe on silver, on a high mark for this move over the next few weeks, and then we'll have to readdress.
I know it's not the right thing to do with charting is to say that something's going to turn bullish before it turns technically bullish, but I'm going to go ahead and say silver is going to turn bullish. I think the industrial demand is going to pick up when the world gets back to work, and I think silver could easily jump up a couple bucks and turn bullish here.
Sure, and we're a weekly show, right? So we're obviously trying to put a little bit of content out there, just kind of looking at these micro moves in the metals on a regular basis. But yeah, you zoom that chart out, look at like weekly charts and monthly charts. Who cares what's happening right now?
Yeah, you're singing my song. That's why I'm here, to point everybody back to the macro.
You and the macro and the fundamentals.
That's right. So,
well, before you jump into the macro, we have to mention the stock market has, with a few of the indices, they have rallied back here, right? We had the big decline, and then it's been rallying back. Well, the S&P came up into the 618 retracement, and it stalled right there. So it's trading just below it, kind of bounced between the 618 and the 50% retracement level. The Dow Industrials failed to get to the 618. It's shy of it, and I think Miles can probably put that on a chart and show it pretty easily. But then also to note, the transports have failed to get back up even to the 50% level. They've really languished. So those are key indications of a market that might want to try to go higher if it can get above those 618 levels. But it sure looks like we've had this big decline in the stock market. We've had this rally back, and it sure looks like it could easily roll over and go down big time.
I agree. I think you're seeing it even in individual stocks. Pick a sector, whether it's travel or lodging or whatever. And I think you see that same sort of price action And it's not unusual to get a bounce off of something, just like what we've had in gold and silver. You get this V correction, sharp correction. It makes up some of the distance, and then it finally lays over and falls one more time. And then we'll see what the real correction is going to be. And it's going to take us a long time. We're in for a very ugly Q2 in terms of economic numbers that may not be realized until Q3.
That's what I was thought you were going to go and say is we saw the Q1 numbers. The real virus impact, obviously, I think is probably where you're going with that, is going to be in the next couple quarters.
Yeah.
You definitely don't know until you see those revised numbers.
Exactly.
So it is Q3 that we're going to see what the initial knee-jerk reaction actually caused. And it's going to be 18, 24 months from now before we even begin to see what our reaction to all this as a nation, and especially the Federal Reserve reaction, causes.
Yeah, well, and that knee-jerk reaction isn't just with what the governments did with closure, right? The knee-jerk reaction is also with what the U.S. Treasury and the Federal Reserve and every central bank did with the response. And that's part of what Robert is attesting to with these equity market climbs is, yeah, look at what they're able to buy now. There's essentially a nationalization of our markets in these times, right? Really probably never to go back, but you get a huge influx of monies either through central banks, which now can buy either assets or muni bonds or whatever it is directly, or you get U.S. Treasury pumping money into businesses. You get the Federal Reserve pumping money into banks that turn around and buy assets. And that's what causes it. This isn't Main Street investors jumping back into the equities markets. And that's why I think ultimately you have to have a further washout, and gold and silver will respond accordingly, much like it has in the 70s and it did back in 2009 to 11.
Yeah, I think a lot of Main Street, individual investors are probably assuming that we're going to have the same type of V bottom in the stock market that they've been so accustomed to, and it's been so forgiving to a stock investor or a stock holder. In the last number of years, we've had the stock market, when it declines, it just has a V bottom and goes right back up and then goes higher. And I think that a lot of people are just conditioned to think that's what's going to happen here. And I don't think that. I think it's going to roll over and go down big time. And a portfolio in stocks is probably a losing hand going forward here, I would say.
Well, keep in mind, too, that that's not an indication of economic health. And that's that investment mindset, that psyche, that manipulation of that, and what the equities markets represents to people, to me, is not accurate. They can pump a bunch of money into the equities markets to encourage everybody to believe that the economy is recovering and doing well. No, we're in for some massive unemployment. We're in for some massive bankruptcies. And you're going to see individual, small business, and major corporate bankruptcies. Now, that doesn't mean they all have to fail, but that's a resetting of debt. And that takes a very long time. And this isn't going to be just a recession. A recession is just a short-term business contraction with liquidations and rising unemployment. We're looking more like a depression, which is a longer term, far greater rising unemployment, and even greater contraction with liquidations.
Well, and the frustrating thing about that type of recession or depression is the two-edged sword, in that you have the initial thing you're talking about, how it's affecting each individual family, employment, cost of living, so on and so forth. But then also, what is the demanded government reaction that the people are requiring their government do? And you hinted at this a second ago that I think is worth mentioning. A further consolidating central power does not easily give that power back. And I think that's something to definitely remember. So we don't just want to focus on how we're getting hurt in the short run. We have to recognize what we're giving up in the long run. And I think that's important for everybody to keep in the back of their minds.
That's a big fundamental reason for owning gold, because it is financial freedom. It really is. Nobody can tell you that you have something that's worthless, and they can't tell you that you don't own something that you do when you've got it in hand. And so that's one of the benefits. But you're right. It's going to be tough. And we mentioned this last week. You've got to listen to the McAlvany Weekly commentary on ecospasm, because it's important to understand that inflation and deflation can occur at the same time. And in 1973 to 1975, the economy contracted and unemployment reached double digits, just like we're seeing now. We had 30 million people file for unemployment in the last 6 weeks now. But at that time in 73 to 75, there was monetary expansion, just like the charts we put up last week. And there was price inflation. It remained historically high. We don't see the price inflation yet unless you look at specific asset classes. We have further deflation to go in some and further inflation to go in others. And that's what that ecospasm is. So listen to that weekly commentary.
So speaking of specific industries that we're likely going to see a little bit of price inflation, we left off with silver, which certainly is due its comeuppance compared to what gold has already done. Shifting over to platinum a little bit, I do want to point one thing out. I was hoping to see this little short-term channel continue up, because just like silver, I think needs to put in a little higher price before we see some retracement. I feel the same way about platinum. Now, platinum did, of course, immediately after we recorded and put charts together, break below that channel. Now, the good news is, as you look at the slightly longer timeline, and it hasn't put anything in near a lower low. So we are still inching up in platinum, and as long as it continues to do that and stays above those previous lows, I would expect to see the silver breakout I talked about a moment ago go up. Palladium, on the other hand, as we've expected, continues to look like it's going to push down.
Weaker and weaker.
Exactly, yeah. So palladium we expect to see come down a little bit, not substantially. I don't think the ratio is going to realign because palladium drops to $400. I think the ratio realigns because platinum eventually gets up and matches where palladium is. So still looking for both of those metals. And getting back to what Tori was saying a second ago, we're talking about the value and reasons and purpose for owning gold on these big macro scales. By investing in things like silver and platinum today, it allows you to own more ounces of gold tomorrow.
So with the lack of activity really in the precious metals prices, the lack of activity in the equities markets prices over the last week, a lot of people are asking why the silence, why the pause. It is sort of the calm before the storm. I heard somebody say the other day that we're in the eye of the hurricane, if you will, but we're coming up on the back end of that. What's happened here is we have a lot of things baked into this pie, and most significantly is inflation that's coming as a result of significant debt and what the reaction has been for that. So that's the fundamental reason right now for adding to your gold and silver position. You hear us say inflation, right? If inflation is just expansion of credit and money supply. Deflation is the opposite. It's the contraction of credit and money supply, and prices drop. Well, you've only really had deflation in this country in 1949, 55, and 2009, yet it's enemy number one, and it's the Federal Reserve's whole purpose to avoid deflation. Well, they're going to get their inflation. So the way they're getting there, too, is just by, again, expansion of credit and money supply. So the Washington Post just released, look, the U.S. Treasury plans to issue $3 trillion in debt from April through June. So that's going to have to be dealt with. The national debt I mentioned last week was $24.5 trillion. Now we're $24.95 in 1 week. But we know it's actually higher than that. That's now over $200,000 per taxpayer. And here the CARES Act gives everybody $1,200 hush money. It's hush money so that we don't raise a stink about the fact that we each owe an additional $16,500 as a result of the CARES Act. That's why you own gold. So with debt to GDP at 113% last week, it's already at 117% this week. And we talked about it on its way to 140. That's like a foregone conclusion. So just continue to remind yourself, yes, on dips you buy. But why do you own gold? Because death, taxes, and inflation are guaranteed in your lifetime.
Well, Tori, I know you mentioned the CARES Act, but we have actually gotten some new information as to how that could actually benefit some people. Despite the long-term costs, there are ways you might be able to use the CARES Act to set yourself to help defer against some of the damage those long-term costs can cause.
Yeah, 401ks don't allow for physical gold ownership, but traditional IRAs do. Well, with the CARES Act, they now have a provision where if you've been negatively impacted by the COVID-19 virus, you can roll up to $100,000 out of a 401k into a traditional IRA now. And through that traditional IRA, we can help you accumulate physical gold and silver and platinum. So, yeah, give us a call on that. That's exciting new information.
That does it for Golden Rule Radio this week. Thank you for listening. You can follow us on Twitter at ICA Gold. Like us on Facebook, McIlvaney Financial. Visit our website, McIlvaney.com. And you can always give us a call at 800-525-9556. Thanks for listening. Have a great week.